At this point in the series, you understand the problem. Circular financing is inflating the AI boom. But that doesn't mean you should avoid AI entirely. The real question is, how do you tell which AI companies are actually worth investing in and which ones are riding a wave that's eventually going to crash? Let's weigh the options. To crash, today I'm giving you a framework. 3 layers, clear criteria, specific red flags. Let's get into it. When you look at the AI industry, there are 3 distinct layers, and each one has a specific function. Very different risk profile. Layer 1 is infrastructure. These are the companies building the physical foundation of data: AI, chips, data centers, networking equipment, power infrastructure. nvidia, TSMC, ASML, Vertiv. These companies sell to everyone, regardless of which AI application wins. Layer 2 is platforms. These are companies building the software and services that sit on top of the infrastructure. Cloud AI services, foundational models, developer tools, Microsoft Azure. AI, Google Cloud AI, Amazon AWS. These have real external customers paying real money. Layer 3 is applications. These are the companies building end-user AI products, chatbots, AI writing tools, AI image generators, niche AI software. This layer has the most hype, the most competition, and the weakest moats. The risk decreases as you go from layer 3 down to layer 1, but so does the upside. The framework tells you where to look. Your risk tolerance tells you where to invest. Infrastructure companies are not the closest thing to a safe bet in the AI space because they sell picks and shovels.
Regardless of which miner strikes gold, nvidia is the obvious example. Whether OpenAI wins or Google DeepMind
wins, both need NVIDIA chips. NVIDIA's revenue is tied to AI adoption broadly, not to any single. The application succeeded. TSMC manufactures the chips that NVIDIA designs, and ASML makes the machines that TSMC uses to fabricate them. These companies sit even further back in the supply chain, more insulated from application layer volatility.
The key question for any infrastructure company: does their revenue come from a diverse set of customers?
Or is it concentrated in the circular loop? NVIDIA's challenge is that a significant portion of its recent revenue growth has come from companies in which it has equity stakes, which is the circular financing problem again. Platform companies are where the analysis gets more nuanced. Microsoft is the clearest example. Our platform now offers genuine external revenue streams. Plus, our Copilot integrations are being rapidly adopted by enterprise clients who are not part of the circular investment loop. Azure AI revenue is growing from real businesses, paying for real compute. Google has genuine AI revenue through advertising. Its AI-enhanced search is serving more ads more effectively, generating real cash from real advertisers. The red flag at the platform layer is when a company's AI revenue is primarily coming from other companies within the same investment ecosystem. If the majority of your AI platform's customers are AI startups funded by your own investors, that's circular. Application layer AI companies are where you need to be most careful. This layer is full of companies with impressive growth metrics, high valuations, and minimal moats. AI writing tools, AI image generators, AI customer. Most of these products can be replicated by a competitor or by a platform company. In months, the test for any application company is simple. Do they have a defensible advantage that won't disappear when OpenAI or Microsoft builds a similar feature? The honest answer for most application layer AI companies right now is no. They're growing fast because they were early, but early is not the same as defensible. That doesn't mean you can't make money on them, but you need to treat on them as high-risk, high-volatility positions, not as long-term holdings. Here's your red flag checklist for any AI. The company you're evaluating, red flag 1, Most of their revenue comes from other companies in the same industry. Investment circle, red flag 2, free cash flow is declining even as revenues grow. Red flag 3, HI risk. Their core product can be replicated by a platform company with one software update. Red flag 4, the valuation assumes growth rates that require the entire AI market to materialize exactly as projected. Red did. Looking here, you see revenues up, but cash flow plunging. Flag 5, their customer concentration is high, meaning 1 or 2 big deals account for most of their revenue. If a company you're evaluating hits 3 or more of these, that's a pass, not what. The link in the description has a structured framework for applying this kind of analysis. To crypto markets specifically, check it out if you want a systematic approach rather than gut instinct. In the next video, I'm going to show you what actually happened to investors who bought into the portal. The last major tech bubble, the dot-com crash of 2000, the parallels to today are uncomfortable, and the lessons are ones that most investors still haven't learned. Subscribe and hit the bell. I'll see you in video 4.